So for inflation, we are trying to measure how quickly prices are changing or the percentage change in prices. And what we do is we measure a standard bundle of goods. So in our example, we're going to do a simplified economy, 3 goods. So we've got rent, movies, and food. This is a simple basket. And we've got prices for 2 different years. So we've got the prices for 2012, and we've got the prices for 2013. We've also got the quantity that's being consumed in 2012 and 2013. With that information, we can come up with the cost of the bundle. And the cost of the bundle is defined as the price of item 1 times the quantity of item 1, plus the price of item 2 times the quantity of item 2, plus the price of item 3 times the quantity of item 3, and then if there are more items, you would continue in the same fashion. So for us, the cost of the bundle in 2012 is the price of rent, $500, times how many apartments we rent 1. The price of movies, $6 a ticket, and we went to 10 movies. And then the price of food, which was $2, and we had 60 meals. And if you add up all of this, you get that the total cost of that bundle is $680. That's the 500 plus the 60 plus the 120. Then we say to ourselves, well, how much does that bundle cost next year? So in 2013. In 2013, rent has gone up to $630. I'm still renting 1 apartment. The cost of movies is now $7, and I'm still going to see 10 movies a month. And then food has gone $2.50 for each unit, and I'm consuming 60 units. And now that bundle, the same bundle of rent, movies, and food, now costs me $850. So what I see is that there has been inflation. So what I can see is that there's definitely been inflation. The bundle used to cost $680, now it costs $850. That definitely costs more than it did before. And if my income is held constant, so I didn't get a raise, then I wouldn't be able to consume the same bundle in 2013 that I consumed in 2012. I would have to maybe get an apartment that costs less than $630, or I would have to cut back on my food consumption or my entertainment. How can we use this information? We use this information to come up with a thing called the Consumer Price Index. And the Consumer Price Index is a measure of inflation in the economy. And the Consumer Price Index, known as the CPI, is simply the cost of the bundle in some time period, call it T, compared to the cost of the bundle in some base year, multiplied by 100. So if we're looking at the Consumer Price Index for, say, the year 2012, we would put the cost of the bundle in time period T, well, that's 2012. The cost of the bundle in the base year, suppose we call the base year 2012, then we would simply put 680 in for time period T, 680 in for the base year, 680 divided by 680 is 1, times 100 would give us the Consumer Price Index of 100. And this is what we expect. In the base year, we've set the index as a reference point. That reference point is 100. And then we know if next year it's above 100, we have inflation. If it's below 100, we have deflation. So if we were to calculate the Consumer Price Index for 2013, we'd use the cost of the bundle in time period 2013, divided by the cost of the bundle in the base year, that's 2012, and multiplied by 100. So the cost of the bundle in 2013, we said, was $850. The cost of the bundle in the base year 2012 was $680. This divided by this times 100 gets us a Consumer Price Index of 125. What this suggests is that there has been inflation, and we're going to use these CPI numbers to actually calculate that inflation rate. So how we use the Consumer Price Index to calculate inflation is defined by this equation. The inflation rate is equal to the Consumer Price Index new minus the Consumer Price Index old divided by the Consumer Price Index old. So if we calculate the inflation rate for 2013, we use the CPI for 2013 minus the CPI for 2012 divided by the CPI for 2012. Plugging in the numbers that we calculated earlier, We have the CPI in 2013 of 125 minus the CPI in the base year of 100 divided by the CPI in the base year of 100. This is equal to 0.25. If we multiply by 100 and convert this to a percentage, we get that the inflation rate is 25%. So from 2012 to 2013, the cost of the bundle has increased by 25%. So if I don't get a raise, I won't be able to afford that bundle. The next part of our discussion will go into what would the raise be that we needed. Maybe one of the most useful equations is this equation here. Your real wages, or your purchasing power, what your money can actually buy, is defined by this equation. Nominal wages, so this is what you get on your check. So your check says maybe you earn $15,000. Then you have to convert that into real wages by this equation. So nominal wages divided by the CPI in some time period, some future time period, divided by the CPI in the base year. And the base year I think about as the reference when I started working for some business, or you might think about it as the CPI, the base year, maybe calculated by some government agency. So if I were making $15,000 in 2013, and the CPI in 2013 was 125, and the CPI in the base year was 100, then I have 15,000 divided by 1.25. This gives me a real wage of $12,000. So even though my check says $15,000, I take it to the bank, I cash my check, the teller gives me $15,000. When I go out to purchase stuff from stores, because prices have gone up, I only get $12,000 worth of real goods. So I feel like I'm getting less than I was before, so I might want to ask my boss for a raise. So rearranging this equation, I can actually solve for how much does my boss have to pay me to keep my real wages the same. So if I started working in 2012, I agreed that $15,000 was a salary that would compensate me for my wages and effort. But then in 2013, things have now gone up in price, so things cost more. Because of that, I need to make more than $15,000 so that I can go buy that stuff that now costs more. This is how I would solve for how much more I need to make. So $15,000 is what I want my real wages to be. I want to be able to purchase $15,000 worth of real stuff. I multiply this times the CPI in time t divided by the CPI in the base year. If I do this equation, what I get is that my boss needs to pay me $18,750, and see how this works. If I had this equation here, I could plug that in. So 18,750 divided by 125 divided by 100, that's what we found before. So this is 18,750 divided by 1.25. If you do this calculation, this should get me exactly what I'm looking for, which is a real wage of $15,000. So after solving for this, this should be $15,000. So even though my check says that I'm going to get $18,750, I take it to the bank, I cash it, the teller gives me $18,750. I go out and I spend those dollars. Those dollars will allow me to buy $15,000 worth of real stuff. And that's what I'm trying to do here when I change the equation like this.